Hi, everybody who's watching us. Sorry we're being late due to technical problems, but we are now back.
Perfect. Well, thank you, everyone, and thank you to Ego and Flashpoint for inviting January to this podcast and webinar on SaaSLounge to talk about co-investments for families. Just to introduce Jano very briefly, we are effectively a family office co-investment community. And the reason we came about was one of the biggest challenges faced by families like myself was we struggle to find opportunities. Nobody knows about families in general. It's very hard to get hold of family offices, and the vice versa. The families find it sometimes very difficult to get hold of good opportunities. And so what you end up seeing is only stuff that is shown to you by your friends, by your closest network, etc. And really, you don't know whether that's good stuff or not. Most of the stuff, there's no way for you to verify, and it's very difficult to be an expert on everything. So if you're an entrepreneurial family in one sector, you probably get the best of that particular sector because people know how to get hold of you. But if you go outside the sector to diversify, it's a big challenge. And so, it's really interesting for me as a family, as an investor, to kind of find and talk to experts. And this is why, personally, for me, I'm quite interested in this whole area of co-investments. And really interested to kind of have this conversation with you, Igor, to talk about what Flashpoint is doing, but also I've seen some really interesting opportunities and deal flow coming from you guys as well. So it's really great to kind of have this conversation and see where we get to and how do you actually make this happen. So
Yeah,
yeah, thank you for having us.
yeah, Michelle, thank you very much. Hi, everybody. So, Flashpoint, just a quick intro. So, we are a tech asset management firm covering three strategies: early stage VC, mid stage growth debt or venture debt. As people know it, in the later stage is direct secondaries. We are 25 people. We're basically supporting Israeli and Central Eastern European founders, and they build B2B software companies across the globe. We've done 67 investments, 20 exits. We have around $500 million under management. We have 6 funds running at the moment. We have 160 investors, most of them actually family offices, including myself. I'm a big LP, and I'm a managing partner responsible for business development, fundraising, a bit of AR. So I'm wearing like two hats, and that's why it's easy for me to actually kind of have this topic, and especially co-investments. As normal kind of investment business, we have fund business and we have co-investments, right? And I think you raised a very, very painful question because normally family offices who are active family offices seeking to invest or investments, they actually meet like ocean of opportunities, like in different sectors, verticals, God knows, and everybody's selling something, and you just go nuts. I mean, like with selection, you don't know what to do. Eventually, you don't do anything, right? Or you just risk. You trust someone and it didn't go well, and you lost money, and you never do this again, right? So the full stop, VC never speak to me again. So I think in Flashpoint we have a little bit different approach. We try different things, and but because of our smaller size, because we started with like fund of 20 million, and we had 90 million co-investments in it. 90. Then we had like 50 million fund, 2016 vintage. There was almost 40 something million of co-investments. Now we run our third fund, still deploying it, 105 million. And we decided to redesign the co-investments, because you're quite right. Why don't you see good opportunities in terms of co-investments? Because if the fund has enough capacity, enough power, enough dry power, money, you will never give this opportunity to outside people, right? Never, right? So the
Yep.
only reason you actually offer the co-investments to people like a first circle, like LPs, right? Let's say, right? Because there's a second circle, like beyond LPs, right? It's only when you have limits, you've reached your limit. You either don't have cash, right, or you reach, for example, the diversification limit per fund, and we have a limit of 15% of fund per company, right? And this is where we actually start offering, co-investments to our LPs, and potentially beyond if the co-investment is bigger in size, or be very big in size. So in our case, co-investments is completely different, because I mean, our strategy, our investment process in VC business is very, very, very thorough, very rigid. We go with a very extensive due diligence. We screen like 1,500 companies per year. We invest one per 200. There's a huge due diligence. We always buy 10 minimum 10%. We always get the board seats. We're always very, very active on a board, right? Trying to help companies manage the business. So we have a big skin in the game, right? So doing co-investments with us is a completely different situation where you're doing some co-investments from a broker or something like this, and nobody knows what is going on. There is no protection of your investments, and so on and so on. We can develop this idea, but I just stop here. Maybe you have more questions.
Yeah, I mean, one of the big challenges that I actually faced, and talking about this was this is the asymmetric problem, right? As you mentioned, and you kind of addressed it in a very interesting way, was why would you give me the best co-invest? And if I were to look at it, what you just said, you already capped out, which means this is probably one of your biggest holdings, and you still want more of it. And you're saying, okay, you'd only have your biggest holding if you have the highest conviction. And for that means that, naturally, it means that probably the company is very good. If you were to take that assumption of that and thinking. But then on the other side, what I would ask is, if I was looking to invest, is what are you looking for from a family office or a co-investor to come on board in terms of anything other than money? Because, yeah, and believe it or not, when I went to some of the good companies, and I don't know if they asked you this question, as an investor into companies as well, but I was actually asked the question, why should we take your money? So, I always kind of like to now, that kind of thinking as well is I've never been asked this question. Normally, when I say I want to invest, they just send me a kind of a form to sign and then a bank account details to deposit the money. But, to be asked a question. So my question is kind of like, what would you like to see from a family office, about when they're investing, what are you looking for in trying to select the right LPs? Because if it's a great deal, you kind of have to be selective on which LPs you bring on.
I understand. I understand the logic. I mean, probably kind of two answers to this question. First of all, because we're in most of the case, 99.9%, we are board member and we are supporting or protecting our stake in the company with potential co-investors, right, who are coming to this investment through our SPV, and of course we are making some carry and some fees depending on the amount, etc. It's all very commercial. And so the company actually see us as a main investor. They don't see all these co-investors because they don't really go direct. And they don't want to be direct because they want to be protected with our corporate finance rights, right? With our board seat, with our understanding what's going on in the business, with our visibility to exit, with our controlling function, right? So this is what family office should seek from co-investment. On the other side, when the co-investment or a family office comes into co-investment, in our case, it's already de-risked opportunity. So it's already halfway through, right? And so because the average timing for co-investment in our case is like less than 4 years, right? It's like 3.6 years of holding period, right? And this is not a fund of 8 years, 10 years, something like this. And it's until exit, right? And we have a good visibility. So that's one answer. Second answer to that, I mean, if we have a choice, right, to look at the family offices, we would definitely look at a serious family offices who would like to be consistent with us. So they would like to not just do one off, but because normally we have 10 to 15 co-investments throughout the year, and these are all our best portfolio companies. So what we look at these family offices, first of all, be consistent, be serious about it, and they're doing this co-investment, and they're also educating about us. So we're building the trust. They see us doing the deal, they see the papers, they see how everything is done, then they see the reporting, they see how they're involved, happy not happy, and we are basically embracing them, and they start being like part of our community, our little family. They're basically LPs, right? So we do expect them to look at some other co-investments, and potentially after this experience, most of these co-investors, I mean, at least good ones, they say, okay, we understand the rule of the game. Maybe we put a little bit in your fund, next fund, because we understand that your fund is making this. It's almost impossible to lose money. And we have always a first kind of because if there are many people who would like to do co-investments, then we choose from those who are closest to us, who are LPs, of course, right? And so this is the exercise on our side. So today our co-investment community, 160 members, maybe 170 members, and we kind of we actually put it into a program or fully automated that, and we're showing this live opportunities and watch opportunities, right? So family office that understands that I would like to make 2 or 3 co-investment this year and I have a budget of, let's say, $2 million, right? They have a chance to actually pick, ask questions, read before, etc. Because most of the co-investments, as you know, they come like this, like a fire, right? So you have 3 days to decide. You have to read like 300 pages. Most of the people, they just don't want to read. They don't understand what they're reading. They are not experts, and this is actually the wrong way to do, unless you are like so confident. This is like another, I don't know, SpaceX or something like this. But it's not real life, right? Reality is different.
And then one of the things you mentioned was really interesting point you there, because it's something that I picked up on. I had a similar experience. Was actually when I invested, I'm like initially thought I want to be on the cap table, right? Which is from an ego perspective is amazing. Yeah, I want to be on the cap table of a company. So suddenly you're now on the cap table of company, but then you are kind of like, unless you're putting in, 100, 200, 300, 400 million, which is a huge amount for a lot of families in general. I mean, some people can do it, but not everybody. Even with that kind of money, depending on the size of the company, you might have 0.5%, 1%, 2% of the company, which doesn't give you sort of any kind of protection as such. Yes, you get on the cap table as such, but beyond that, you're kind of limited as such. In that reason, I'm guessing, which actually makes a really interesting point. But on the contrary, if you think about it from the other side, if I'm a co-investor in your SPV, how does the voting mechanism work? I mean, how do you actually kind of run this? If you were to say, just pick any one of your transactions. And you said, okay, hey, we've got a 10 million transaction, and 5 million or 6 million is from the fund, and that's the maximum we can allocate. 4 million is to co-invest. And then when it comes to board decisions, etc., like that, do you kind of take the decisions back to the investors, to the fund and the co-investors, or how does that kind of
Oh,
mechanism work?
it's a very good question. Thank you very much. I mean, indeed, there are 2 types of family offices or investors, because it's not just family offices, right? Some family offices are like $10 billion organization, right? It's hard to say
Yeah.
that they are just little family offices, right? So indeed, some people do want to have like a direct exposure to the company, and I mean, like, fine to do this, right? If we have a good level of relationship, we can introduce them directly to the business, to the founders and management, and they may do a direct deal, right? We make some little fees on that, etc. Or carry, it's all very commercial. If really people want to do, but they need to realize, and you're 100% correct, that then they are one-to-one with any potential issues, problems, information asymmetry, etc., etc. And God knows what may happen, right? We all see how many black swans are flying around these days over the last few years, right? Do you want to be kind of facing these realities, or not really, right? Or you want to be in good hands, experts, and the board members who've been kind of, developing this relationship with this founder, company management for years, and we are part of the board, etc. So I think this is very important. I mean, if we sit on the board and we actually comprise all these holdings, right, we actually act on behalf of all shareholders, right? And I can't say that we necessarily consult with little family offices who are participating in co-investments. It's not really because we act in the best interest, and we know. I mean, first of all, we are the largest LP in every fund. Okay, and normally we put most of the money, so we're like super motivated, right? Our motivation is coming from like 40 million of equity that we have, and we invest first, right? So that's important, right? So most of family offices who trusted us money through co-investment, they rely on our expertise, on our protection, and on our judgment, right? And this is how it is happening. Some people do demand, they demand kind of direct for different reasons. Could be tax reasons, for example, right? They demand just direct participation. Okay, if we keep you happy and we satisfy your desire, we can do this. I mean, it's not a big deal. Some people don't want to pay any fees. This is also accepted. And if we would like to keep this relationship going, here we are. We just introduce everything, but we don't do anything because, I mean, normally we're doing all the papers, all the work. We keep SPV costs associated, etc., etc., etc. But if people really want to be direct, I mean, we're always happy to help them, and it's a dialogue. People learn. We're here to help investors, and one day they may become our investors, etc., etc. So, I mean, but most of the cases that people, when people consider co-investing, they go through us, right? Because it's just simpler. It's more controlled. They can ask any questions to us anytime, right? We just answer. Normally, we answer within 24 hours. We have all the information. We have all the data room. We are basically looking what's going on in the company. We see all the beats, discussions, negotiations, and so I think this is very important. And I can tell you, for example, our recent co-investment was with our leading company from Israel, and the deal was with KKR. And some of the co-investors sold out, so they sold to KKR, and some new joined us, right? And actually, because we had a pro rata, and we could have participated, it was like 4 million co-investment, and those who sold, they made between 3 and 6 times. I mean, it's crazy. I mean, it's like they are super happy. Right? These guys are now considering to give us more money under management, basically, right? So I think I'm just telling you. So most of the co-investments we had is like IRR 40%, 66%, 151%, 42%. Preply recent one 29%. So this, I'm just reading the statistics. Sorry, I don't remember this by my heart. So what is the message? So the message is, if you do it right, you're getting kind of very secure. Well, like very secure. It's all risky, but you 50% the risk, right? You have a good visibility of exit. You understand what's going on inside. You understand the cap table who are around you, right? For example, in this deal with KKR, we obviously like 10% shareholder board seat, but just beyond us, there's Michael Dell, Apex, Sixth Street, and KKR, Viola, all very respectable names. You can't get such a co-investment from the street. Don't even try. It's impossible, right? So that's another thing. I stop here.
So here's the thing. I mean, now you're making co-investments seem really interesting, right? So I have to ask you this question because you're an LP and you're a family office. You've done this investment before, so you've got the opportunity of co-invest, and then you've got the opportunity of investing into your fund, right?
Yeah.
Now, I mean, if I were to choose and you just give the stats you've given me, I mean, those are amazing stats by any standards, whether you're a fund investor or not, putting from the co-invest that you're putting in, all of that. So now, what is your rationale for actually investing into kind of your fund? Because I mean, obviously,
thank you.
it's really
So,
interesting.
very good question. Well, first of all, fund is more diversified story. It's a longer term. It's a longer in terms of timing. But I mean, my judgment personally, it's my personal view that the best investors, like people call them lucky investors, but not lucky. They just good and thoughtful. So they invest in the fund, and they do also have budget for co-investments. So in a way, you invest a little bit. Let's say you put a little ticket, I don't know, million, half a million, 2 million, depending, for different family offices, different levels, right?
Yeah.
You secure your interest, you secure your kind of place, and you secure kind of the proposal. Like so you see all these co-investments. You have like a first choice, right? First right of the first choice, right? And this is like some very smart and big investors, they put even more, like that 1 million. They can put 10 and saying, listen, I have to be like amongst first who look at the best and I do have to have a chance to put more into like co-investments. So if there's a 10 million, I can take the 10 million. I mean, I'm probably talking extreme cases, but this is ideally what you would like to do to maximize your IRR. right, from the investment activity, right? So you're relying on the experts. They are doing the business, they are doing screening, filtering, investment. It's all hard work, right? Then you capitalizing on this, doing the co-investments, which is also quite risky, but it's twice faster towards exit, and in combined IRR is like super attractive. I think this is the best model, right? What I've seen in my life, right? I don't say that I'm the best VC expert or investor. I'm like not the best, and and I'm trying to learn more. And all life we're all learning. But I think this is the best combination because I mean we're all humans. We can't be experts in everything, so you have to rely on good experts, right? And I think the ability to select good expert from bad expert is also kind of quite a talent, right? Or relationship, or trust, many other things. So, I mean, my advice is like if you're starting this business as a family office, don't know what to do, right? Try do little co-investments, see how people perform, kind of get your results, get closer to managing partners, understand the investment process, understand the strong side, weak sides, understand kind of what do they expect, what is their personal goal, kind of whether there is a fit or not. If there is a fit, try to stick to them and do the business together. And normally in portfolio you can't have like 100 funds, right? This is like it's very difficult, right? Normally you have a couple, and you stick to that, and you do this business, and then you exit, and exits, I mean average exits in our for our co-investors make them like gross north of 4 times, right? The net will be a little bit lower, but still it's a very good result, considering less than 4 years holding period. Don't get me wrong, right? When
Yeah.
we're not talking about kind of 100 times, decacorns here. I'm just like talking about real things, which are just around us, right? And this is what I would advise most of the family offices do, right? Take step by step, learn, build trust, increase kind of your deployment, but in a smart way, right? So that's the thing.
And I mean, so I mean, if you kind of were to think like when I'm building my portfolio and capital stack and kind of trying to diversify as well, if you think about it from that perspective, obviously, for taking a small stake, as you say, in your fund, what it does, it gives you exposure to multiple opportunities. And then if there is an opportunity, because for investors, it's never guaranteed. It's only when a great opportunity, you might have one, two, maybe you might have 10. You don't know. I mean, until the opportunities come up as the fund is kind of developing and the companies are developing, you can then add on some more alpha on top, if you call it that way. So you can actually say, okay, I'm going to get my base return, but now this is kind of supercharging the returns by taking some selective co-invest where there is maximum confidence to kind of add to that. And then I guess, and this is now a separate question because I know we've kind of looked at some of the stuff that you've done before. Is then you can also consider probably debt element of it. It could be that there might be because then if imagine in your company, and this is the reason I'm asking it from a personal perspective was I actually invested in a company as an equity player. Then I invested in the same company when they did a private equity round. So actually got liquidation preferences, etc. And then what happened was they needed some kind of venture debt just to pick up some contracts as such. And so what you're doing, you're protecting your capital stack. So technically, you could actually do that, I guess, along the way to kind of pick it up. Would that be fair? I would say.
No, absolutely. I mean, our approach to co-investments, as I said, we're trying to be very transparent. So we're showing our investors like all the co-investments like 10 months in advance, and they're equity and debt. For example, some companies are growing super fast. They are super nice and healthy economics, and we already gave them like 20 million of debt from our debt business. And we understand that it may not be enough. So we invite potential co-lenders, right, or co-investors in this way, actually to do this business. And our debt business is generating like 15% net IRR. It's not bad, for that business. Okay, and okay, it could be not in the form of LP, but in the form of a partnership, basically, right? And we are open, to this. And it's probably not that often as VC, but so equity, so that business requires some knowledge and structuring, etc., etc. But you actually capitalize on our structure, our agreements, our due diligence, and everything else. So you just join as a partner, and you do this deal, right? So we've done several of those in the past, and we're now offering one opportunity in the next few months, actually, like this. So it is possible. The other things which you didn't mention, and I would like to mention this, is like when you invested a little bit in the fund, and you can do also co-investments, but as you mentioned correctly, you cannot go. I mean, the co-investments are not guaranteed. It may happen, may not, right? It's like something went different way, etc., etc. No co-investment, but you can always say like, listen, if there is a secondary opportunity in your fund because something happened to this LP or that LP, and I'm more than happy actually to take that position with a healthy discount. I don't know what it is, 15, 25, 30, 40% discount. It depends. But that's also a way actually, to make extra IRR on a shorter period of time, right? But people, right? So you are part of the community, right? So you're one of the LPs, and you raise hand and say, hey, if anyone is selling, kind of, I would like to take a look. Yes, and
And actually, it fits in really well with the kind of family office community, I guess, from that perspective, because
absolutely.
in essence, you're actually building the community. And sometimes, when you have transitions within families, next generation, or there is whatever, there are many reasons. And there might be, restructuring of the families, there might be splitting of the assets, etc. You do have these situations where people want to kind of just transfer the assets, or they want to sell to generate some liquidity for whatever their families might need, etc. And so that's a really interesting point around the secondary. So is there kind of what do you call? I know in the listed markets, if you call it, there is a lot of secondaries trading sometimes, or pre-IPO companies might have some secondaries trading just before they're going into IPO, because for whatever reasons, some of your companies actually the employees might be selling. We've seen a lot of that coming from the US US companies, Starlink and SpaceX, etc. There's a lot of secondaries going on. Do you have like a kind of a secondaries platform or product? I mean, if I'm selling or
Yes,
buying,
it's
how can I walk
yeah,
for this
like
transition?
a very good, very good question. I mean, our co-investment program actually works um, throughout VC business, that business, and secondary business. So some co-investment opportunities are actually pure secondary, right? And I can give you a bright, like exact kind of a good example, right? The recent deal
Yeah.
which we've done in Preply. And Preply is education. It's a number one marketplace for tutors in the world, right? So it's actually a Ukrainian founder. The company is American, headquartered in Barcelona, so like very, very international, making like $130 million of revenue today, right? I mean, we accumulated a stake of 4.8% through secondary, right? Because we were not lucky to get through Series A, Series B, we missed that, right? Then we got lucky finally and got it through the secondary, right? And there was another round. So some employees were selling, co-founder was a little bit selling, and we got a very good price. I don't remember how much, but like 20 or 25% discount. I don't remember, but that was a kind of deal for us, okay? But because of the limitation of the fund, because we already spent like $9.2 million, right? And it's like, we're just that's it, we can't do. So we still took it, right? And but only for the benefit of the co-investors, because there was so many people actually asking for this, and we had a quota of like 4 million. Eventually we got squeezed down, right? Because there's so much demand. So we did like 2.4 million, right? And this is what we got finally, right? You see how competitive it is. And this is exactly kind of the situation that you just described, okay? So that was an opportunity, and it's a very rare case, and people just got it, quickly. And there was a lot of demand, but what, I mean, there was only 2.4 million. That's it,
And just talking about something, one of the big challenges of co-investments is actually because they're different rounds. Sometimes the terms and conditions of each round, the Series A might have different liquidation preferences, or earlier rounds might have different liquidation preferences to Series A, or Series B might have different terms, etc. When there's a secondary opportunity, do you actually kind of do the analysis and say, hey, this is a
of
great
course.
opportunity, and okay, so you
Of
and then
course,
you kind
of
of
course.
equalize that basically.
Yes,
Okay.
yes, yes. I mean, it depends what you're buying, which class of shares, how protected.
Yeah, yeah.
Sometimes you're buying really kind of very nice position, protected, and sometimes we manage to get even to the board through the secondary deal, which is amazing, right? I mean, of course, it requires some financial corporate finance skills and negotiations, etc. But many people would like to see us actually on the board because we have a good experience, right? And we are, I mean, like we are value add, on the board rather than just destructive, because many people say, VCs, they don't do anything good, they only destruct value, and etc., etc. I mean, like, I can tell you that we're probably trying to do better, right? Again, I can't judge myself, but this is
Yeah.
this is what we see. Okay, so there's always diligence of what you're doing in primary or secondary, right? And you're trying to offer the best, right? Because I mean, as I said, in most of the cases, these co-investors become our fund investors eventually, right? And they stick with us forever, like for forever. We are 12 years old, so it is forever, and they like us, right? And otherwise, how do you build trust? How do you ask them to invest more? Only through making more money to them and showing them better opportunities so they can actually stay and roll their capital, right? And I think that's also a good merit for potential due diligence for any family offices when they look at these co-investment opportunities. Who is offering that? Why they're offering that? There's reasons. But honestly, the life is short and it's tough. Everybody's busy, so it's much better to do like this trust building step by step and understand who are trusted investors, who are trusted experts, and then it goes very quickly. Like, guys, we now understand. You like it? Do you put money? Yes, we put money. Okay, I'm in for like whatever 300, 500. This is a normal conversation with family offices, right? I mean, and then we're just reporting, kind of sending, and then we spend time with them explaining what's going on, when is the exit, this and that. But this is kind of life, right? But family
And,
office is not a football team, right? So normally they are like quite squeezed in terms of specialists, and so that's why I think it's all about people, right, and trust, and relying on expert opinion. Yeah.
And in terms of, you mentioned something about reporting. So one of the big challenges as well is not all the companies are amazing at reporting back. Sometimes you just get an annual shareholder letter. Sometimes it might be every month, sometimes it be every 6 months. In your case, I mean, does the company do the reporting, or I mean, how does it work with your kind of investments as such?
Yes, this is also a very good question, and this is why we're different from many other colleagues on the street. So, first of all, we report to our LPs on a quarterly basis, right? And while preparing this report, we revalue net asset value of each portfolio company on a quarterly basis, right? So that gives just excellent understanding what is going on in the company. So investors is getting from us like financial statements, portfolio reports, right? And they can ask numerous questions, what is going on. And normally we also present like putting together a presentation going through all this and discussing each single every quarter, right? Every quarter, which means that these companies, our underlying companies, they have to report sooner to us. They should have a CFO in place. And normally this is our job actually to push hard on HR front, actually to hire right people, because this is where actually most of the companies are not doing well, and they don't know how to hire, right? Not just CFO, CEO, COO, but also salespeople, etc. So this is a separate question, right? So our co-investors, who we consider also as LPs, they get quarterly information on what is going on. Sometimes we're doing a separate call with those who require this, and they ask more questions, right? So we're just going and explaining kind of a little bit more than in this reporting. So I think this is very important, right? And that is how our co-investor is like a little bit more informed, like regularly, kind of understanding what is going on and what is our recommendation internally: hold, sell, or buy this opportunity. So that's the point.
And in terms of, one of the really interesting, valuable bits about the community and having families and LPs, are that a lot of families, they made their wealth in a particular industry sometimes. Some of them are first generation, some of them are seventh generation. There are multiple different areas of that. if when a family is investing into some businesses, sometimes it's just a pure financial investment diversification. Sometimes there might be a strategic angle. I mean, have you had situations where you've actually picked up, your family is coming onto one of your companies because I know there was one which there was one might be in the property industry, something like, let's say somebody from Airbnb or somebody like that comes in, investing in that. Have you had a situation where the families become really important, and actually it's co-investing, it's great, but then it's almost like a strategic value add as well. I mean, is that something that you look for, trying to find families within that region, or
Well, I can tell you that we have events, like let's put it this way. So we're doing a lot of hospitality and we're doing a lot of prop tech. Okay.
yeah,
So most of the people who are in real estate, actually this way or another, they just love the hospitality and prop tech, probably more prop tech, right? And those who are, developers or in construction business, they also like, for example, construction tech. We have construction tech and logistic tech. And they just like wow, this is so interesting. When I've seen that before, can we just look and can we talk to the founder and the CEO? So you're quite correct. Most of the family offices, like or conventional business family offices, sort of, they tend to see or look into things that they know, they understand. Sometimes they're actually experts and we're talking to them as experts, right? I mean, don't get me wrong, we have about 500 experts actually.
mhm.
And so it's interesting. I mean, for example, we have one of the top construction developers from Dubai. Don't want to say the name, but like top. And they specifically ask, like, show us all the prop tech kind of opportunities that you have. We're gonna look at them because we're actually buying kind of these companies, or we kind of take their services, or we would like to meet them, and then we start introducing these guys, and there's a dialogue, etc. And they haven't invested yet with us, but we're just talking, and eventually probably they will invest, right? But this is the process of building a trust between myself or Flashpoint and the potential investor. But you're quite right. I mean, some people are like focused only on specific areas. That's true.
And I'm just talking about this as SaaS, obviously SaaSLounge, and software
Yeah.
as a service. So you got a lot of exposure to prop tech, etc. We talked about ed tech. Just now, one of the companies, which is the US with Barcelona, and then Israel, Ukrainian, sorry. What are the kind of segments that you kind of shy away from within SaaS? Because it's quite easy to point out to sectors that you probably like, obviously prop tech and stuff, but
Yes.
what would you not be?
I mean, like, we're trying to be conservative because we have our own equity. We're careful, and we try to be with the businesses that we can model, okay, that we can see the outlook, that we can do the stress scenarios, right? That can survive. I have to be honest, right? So we run it as a bank, basically, And I mean, the businesses that we don't have the expert opinion, like life science, right? For example, or like deep tech, right? Or space, gambling, we don't do. We don't do cannabis. We don't do. Uh, Gambling, we also don't do, right? So those things that we have zero. I mean, like also crypto. I mean, we are not experts in crypto, right? And some people making a lot of money of that, wish them luck. We are here, like, I mean, first of all, we have fiduciary duties to our LPs, and if they want to invest in crypto, they can do it elsewhere. We just stick to our sort of DNA, and because this is where we print returns, that we have a good track record. This is why we're different. That's why they gave us actually money, right, to manage. I think that this is very important, to stick to your strategy, right? And we're number 4 fund right now. We're sticking to our strategy, and we are kind of making more than 3 times net cash and cash for our investors. And I think this is what is important, actually, to make a consistent return to LPs. And I would like to have a sustainable investor base, sustainable LPs who are sticking with us. And we have, I don't know, today I have 160, maybe tomorrow I'll have 260, 300. So I have like my own little marketplace, basically, right? And people trust us and we build a business, right? Because sometimes we see very good opportunities, we just don't have money, right? And that's the problem. I mean, it's like natural problem, right? Of successful people. So you have more projects than money, right? But so that's the thing. And I think when you see these funds that doing everything, you have to ask yourself 100 times, do you really want to do this, right? I mean, why these people are different, what they do better, because I mean, if you want to have a super diversification, go invest into Standard and Poor's, go invest into index fund. It's like ETF. It's much safer, honestly, right? But if you want to have return like 30% IRR, and more, you definitely have to stick with right people, right? And this is it's a long-term game. Don't try to make money in 1 year, 2 years, 3 years. This is a long-term game, and you have to be committed, consistent, and disciplined in this business, because it goes up and down, up and down. And you have to just stay calm and continue doing what you think is right and talk to your experts, and eventually you will be there. Eventually you will be there. Not for everybody. That's why I always say to family offices that you guys have to think about your strategy, your investment process, how you do it, and how much money you have, what's your allocation, right? And technology today, I think it's a must have. 1% allocation, 2%, 10%, 20, depending on the risk return sort of tolerance, right,
Yeah.
of any family office. But it's absolute sanitary norm, actually, to treat your capital like this if you want to not just preserve it but actually make something, right? And I'm not trying to teach here kind of wealth
Yeah, yeah.
management lesson, but I think this is important, and I appreciate that we have this conversation, because co-investments is like a little but significant role in everything, kind of in this little ecosystem of investing into technologies. Let's put it this
And yeah, and I just want to say to the audience, if anybody has any questions for either myself or Igor, just pop it into the into the comments, and we will be pick it up as we go along. So just want to put it out there. If there are any questions, just put it in the comments. But I mean, coming back to this whole, in terms of the role of co-investment, which you just touched on as well. I mean, obviously, it is now becoming more and more interesting. SPV investments. I mean, one of the big challenges a lot of people have faced since 2001. You had the huge uplift curve, basically, in terms of you know people investing in the pandemic, and then you had this sort of the slowdown, the slump because of the high interest rates, and a lot of people are hurting, etc. uh, you know, Obviously, that creates two things. One is a cash flow issue, not just for fund managers, but for companies on that side as well. And secondly, it does is also create a lot of opportunities, because then you start to see really good companies start to make money because they have to survive, etc. From your portfolio perspective, as a whole business, Flashpoint, equity, debt, secondaries, etc. I mean, which sectors have kind of come into their own? Which sectors are really kind of productive now? Because not, because this is the perfect environment for them, and they're really kind of taking advantage of that.
Well, I mean, you're quite right. We have a so-called new normal, right,
Yeah.
in this business, right? And we are going through this healthy cycle where tourists are leaving this business, right, or left or dying, right? And unfortunately, these tourists actually disrupted the market a lot, because people trusted the money. People, I mean, investors, and this money basically evaporated, creating basically a collapse, right, in the system. That's why there is no distribution, or very little distribution, and the whole system actually stopped working, like it was before, which caused another kind of consequences, like completely, you know new value, not new, it's normal valuations, right? We're back to normal. And so all of a sudden, VCs, professional VCs and professional investors have opportunity to invest in a very good companies. Actually, a very good time now to create a new vintage. Probably what will be one of the best vintages. It's not me talking; it's expert, right? And yes, some people don't trust with new money in the industry because they lost money, etc. But it goes in cycles, of course, and now it's another cycle, another kind of lessons learned, but beautiful opportunity actually to buy into new companies at a very nice valuation, right? And the valuation will go up. Tomorrow we will see stock market back. There will be a line of IPOs and then exits and many other things. And we already see that activity is back, right? I can tell you, like more money per deal, kind of more attention, more competition. It's already happening, right? It's already happening. So we'll see. But yeah, let's just stop here. It's
Yeah.
I mean, in
No,
terms of sectors, you ask which sectors. I can tell you that some of the companies that we have, they made some cost cutting, timely cost cutting, and today they some of them are profitable, some of them are break even, right? Which was unseen, a couple of years ago, and today this is the case, right? And it's actually good, especially those companies who are actually approaching kind of the public markets, right? And they're getting kind of on a break even or in little profitability. So they're getting ready to IPO in 1 or 2 years or 3 years, and that's pretty normal, I can tell you, right? Sectors, hospitality is one of them. PropTech is also one of them, right? Probably less on other kind of things. But
and
generally,
in terms of just thinking about this element as well, is I mean, I've seen generally in the market a lot of, and this is in fact a lot of families are actually going back into business. It's really strange. You've had a lot of people, whose parents have sold off the businesses, and the new generation is coming in and saying, "Hey, my parents sold off a business in, agriculture or in property, etc." We get it, but right now is a really good time to go back in because, as you said, the opportunity is very good. I mean, are you seeing a lot of repeat founders, like exited founders, come back for second or third companies coming back into the market from your perspective? Because I know I was just reading a little bit about some of the other stuff that you've done just now, and I've seen some of your exited founders are now also part of your team. So are you
yeah.
seeing your exited founders now going back and saying, I'm going to start a new company?
Well, in general, kind of, we are living in a time of a huge transition of capital between generations. Okay, again, it's not me; it's just a fact, right? And it's just the beginning, right? So it's $1 trillion. Let's put it in a dollar terms, of changing hands from one generation to another. Is it first, second, third, etc. But what we see, and we have a good example of our new partner who just joined us in Tel Aviv, and he was the founder of the company that we sold to Providence for 100 million, right? And it was his third or fourth company that he sold, okay? And he finally decided to join us. And it's pretty interesting experience because the guy has different mindset and different approach, and he built the companies with his own kind of arms, right? And so that is important. And honestly, what I see is that some of the family offices with exits before, etc., they're getting really professional, right? They act like a fund of funds. I have to be honest, right? Across many strategies, and sometimes they go into conventional businesses that they like and they know, for example, right? And but also they trying to diversify and invest into alternative investments. This is what I see with people who are learning and trying to be more professional, right? So it is happening. Depends where, right? Depends which geo. Europe has been always more conservative. US and Asia will be more dynamic, I would say. Middle East is completely different story. But generally, because of this change, right, you see kind of also the change of tastes, of spirits and dynamics, kind of what people would like to do, right? I mean, that's and there is a choice, right? Because credit business or debt business today is also quite profitable, right? Equity business is a different story,
Yeah.
and some people like crypto. It's a completely different story today, right? And some people like art.
Yeah.
New asset. I mean, it's not new asset class, but today is like more and more and more like an asset class, and less people like real estate. I have to tell you. So there is a kind of deviation from real estate because probably high mortgages, kind of the cost, etc., etc. So people are migrating between the asset classes today, and this is something that I haven't seen for a long time. And I've been working like in UBS and wealth management. I've seen a lot, right? I can tell you, right? And also, there's other thing just to finish, is that a lot of people try to leave today, right? And because the COVID and other things, they just would like to leave today. So you see a lot of different changes in moods, etc. I stop here because we're running out of time.
Yeah, no, and then no, thank you for that. And I know you guys are going to be traveling quite a bit. I just saw something on LinkedIn. You guys going to be in Berlin?
Yes, we're in Berlin. Yes, attending, exhibiting, talking to many people. I think yes, it's like this is what we're doing in early June, and a couple of other things in Monaco and in Europe, potentially in the US, together with you in Palo Alto and hopefully Mexico. We'll see. Yeah.
Yeah, no, fantastic. Well, I don't really have any questions from my end. I mean, I really enjoyed this conversation. I think
So
so. Thank
thank
you
you very
for.
much. People can find us. The world is digital. You can ask questions. Happy to answer. Thank you.
Thank you very much. Right. Okay. All right.